The Wall Street Journal recently ran an article on what has been on a lot of people's minds lately, which is interest rates and how that affects their decision to move in 2024. But before we jump into that, make sure you hit subscribe below to stay on top of all of the latest Huntsville, Alabama real estate news. Now, most everyone had been predicting rate drops for 2024, including the Fed. They had penciled in 3 rate drops for 2024, but a lot of people are now starting to doubt that due to the high inflation numbers. And then just a quick side note, the Fed does not directly impact rates. They're more tied to the 10-year Treasury. However, it is kind of all tied together, and as the Fed rates come down and Treasury rates come down, we do expect to see 15-year and 30-year rates drop. However, inflation is elevated, and so a lot of people are starting to question that. So now we're not quite so sure with inflation data coming in hotter than expected. That CPI data was 3.5% in March, which is north of the 2% number that the Fed is shooting for, and the primary drivers of that high CPI were both shelter and energy. Shelter, I believe, makes up about 40% of that category. And so having a high shelter cost with housing affordability of higher prices and higher interest rates is affecting that CPI numbers. And it's very unlikely that, one, shelter is going to come down because even with lower sales of about 11.3% decrease in March, we still saw year over year price increases. And then energy is very unlikely to come down as well because of all the uncertainty that's in the world right now with wars and potential wars on the horizon. So shelter and energy costs are likely to stay high. And with that, the Fed is typically leans in that scenario of keeping interest rates higher for longer as well. So inflation is north of where the Fed wants it to be. Their target goal is 2%, which personally, I don't think we're going to be able to hit that number. And I think it's kind of fool's gold because of the debt levels that we have in this country and then the deficit spending that is likely to occur. Both presidents had deficit spending, and regardless of which president gets elected, I think that is going to continue, and deficit spending is inflationary. So again, I don't think we hit that 2% number. And then the other thing is the Fed is really in a tight spot right now. If they lower interest rates, that could potentially create more inflation in terms of increased prices on homes. However, if they don't lower interest rates, that could also increase inflation on housing. And the reason for that is a lot of builders have put a lot of their projects on the sidelines with higher construction costs and then ultimately higher borrowing costs with interest as well. Because a builder, if they build a new development, multifamily, single family, whatever it may be, they have to go and get a construction loan to build that project. And a lot of construction loan projects right now are between 8 to 10%. So if, for example, let's say you want to build a $500,000 home and the construction loan is 10%, that is $50,000 worth of interest that is added to the bottom line of a new home right now. And so, having 10% rates, 8% rates is a huge inflationary environment for new construction versus having like a 4 to 5% rate. That gets factored into the cost of homes. And then the other area that you got to think about too is since these builders are not building as many homes, that's a lack of supply introduced into the marketplace. More supply helps with overall affordability and prices. And so since we have less supply than we need, that is going to continue to be an inflationary event and continue to drive inflation numbers higher than that Fed 2% goal. So in a normal year, I don't think we see interest rates come down, and that's because inflation being higher than the Fed's target of 2%. However, I do think we should have interest rates come down, probably not down to the 2s or 3s, but we need to find that sweet spot somewhere in the 4s to 5s to get more supply introduced into the marketplace. I don't know that the Fed realizes that yet. And so in a normal market, I don't think we see interest rates come down, but I still think we have a shot for interest rates to come down in 2024 because it is an election year. And you look at something that President Biden recently said. He said, I'll bet you see those rates come down more because I bet that little outfit that sees interest rates is going to bring them down at a recent campaign rally. So again, I think interest rates could come down due to the election. It's just not as really a slam dunk as we thought just a couple weeks before now that inflation numbers are higher than anticipated. So overall, over the next few years, I think we're going to see rates really in that 6 and 7% range, unless the Fed figures out that they got to get rates down to increase supply. Outside of that, I think we could see rates in the 6s and 7s really for an extended period of time, because those are really average rates that we've seen across US history, not not the last 2 decades. And based on the Fed's policy of trying to get inflation down to the 2% level and the fact that inflation is staying above that, again, I think rates could stay in that 6 to 7% range over the next several years. So after these 2 decades of having lower interest rates, we might be entering into this new normal period with the higher debt levels that this country has, deficit spending, and all this money printing that the Fed and the government is doing, and really the additional risk level as well. Typically we have 10-year Treasury yields spreads between the 10-year Treasury and the 30-year mortgage rates of about 1.7%. So a 10-year Treasury is 4%. You would typically see a 30-year rate of about 5.7. But right now we're seeing a spread of 3% due to just all the risk that's associated with potentially interest rates coming down, wars, debts, everything that's going on in the world. It's really unlikely that that spread comes down very dramatically in the near term. And then the other thing is potentially quantitative tightening from the government. They've got a lot of loans on their balance sheet that they said, $2.4 trillion worth of mortgages on their balance sheet that they said they wanted to offload. They've really kind of stalled that now with interest rates starting to increase. But if they were to start that program back up, that would have a huge impact on interest rates and push them up very quickly as well. So if you're a buyer, you may be wondering what to do. Well, I think you follow the smart money. Investors are buying. Blackstone has been all over the media where not only have they been buying, but they've been encouraging other investors to look to invest as well, as they think the market has bottomed out. And single family home sales to investors has hit a record high. And so my advice is life continues regardless of the interest rates. Job promotions and marriages and babies and empty nesting, and really in renting, you pay 100% interest. And so if you're a renter, you want to get out of that scenario as well and start to build wealth. So inflation has stayed high due to the housing market and energy. With high inflation, it looks like higher interest rates could become the new normal, even with that dip of 10.1% in sales volume. Housing values have continued to rise as a result of all that. Energy is unlikely to come down with ongoing wars and potential escalation in the Middle East. So waiting for lower interest rates is likely going to cost potential buyers with both higher prices on homes due to inflation and the lack of supply.